Recessions are kind of like the Thanos of the investing world. They can erase all of your share price gains with just the snap of a finger, and along with that, your dividend income can disappear as well. Which, as a dividend investor, is one of my greatest fears. We've already seen a couple companies downsize their dividends, like VF Corporation and Intel, which, as a shareholder, stung like a fistful of Infinity Gauntlet straight to the face. So in an effort to completely avoid all of that moving forward, I'm sharing 5 defensive dividend stocks who don't seem to be at any risk of cutting their dividend. In fact, they have a proven track record of being able to do the opposite and beat the market even through the tough times, which I'll show you later in the video. But before we get to that, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Anyway, guys, moving on, the first stock on my list to talk about today is Johnson & Johnson. And when it comes to recession-proofing your dividend portfolio, Johnson & Johnson is basically like the fortress of solitude. This is one of the most defensive stocks out there. Even when the economy is going down the drain, people will still need to take their medications. Think about it like this. Arthritis, cancer, diabetes, these are all things that people can't just stop treating because they're strapped for cash. So Johnson & Johnson's medicines are likely to keep bringing in revenue no matter what the economy is doing. Furthermore, their portfolio of pharmaceuticals is spread out enough that they're not too dependent on any one drug or treatment, which is good. So their earnings aren't as likely to yo-yo up and down when the market gets rocky. All in all, Johnson & Johnson is a titan in the healthcare industry and has an impeccable track record of safeguarding the dividend over a number of decades. As we can see here, Johnson & Johnson has a dividend growth history of 60 straight years. So they've been growing this bad boy since Please Please Me was first released, which is longer than many of us have even been alive. And I actually have Johnson & Johnson in my portfolio, guys, starting to become one of my bigger positions. If we take a look at my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to it in the description of this video. I hope you check it out. But looking at this, we can see I have just over 20 shares of Johnson & Johnson at an average cost of about $164 per share. And right now my position is definitely getting down there. I have a current loss of about 7%. And as Johnson & Johnson's been coming down in share price, I've been taking this opportunity to add more to this position. And it's become a pretty big position of mine, guys. About 7.3% of my portfolio is in Johnson & Johnson, and this is only third behind Procter Gamble and Starbucks. Anyway, moving on to the second stock that I think is a pretty resilient one to own. We're talking about Realty Income, who owns a portfolio of over 12,000 properties that primarily focuses on freestanding, single-tenant retail in over 80 different industries. So the rental income stream is very well diversified. And their long-term triple net leases help them generate stable cash flow even during economic downturns. And since the tenants pay for all of the expenses on the property, Realty Income is more protected from inflation and rising prices as they pass those cost burdens onto their tenants. Moreover, the tenants themselves are pretty defensive companies in non-discretionary industries and include businesses like 7-Eleven, Kroger, Walmart, Walgreens, Sam's Club, and FedEx. And as far as the dividend goes, they don't call it the monthly dividend company for nothing, guys. I'll tell you what. Realty Income has paid uninterrupted dividends since its founding in 1969, and as we can see here, they've been growing that dividend for the last 26 straight years, all through the dot-com bubble at the turn of the century, the great financial crisis in 2007-2008, and through the COVID crash just a couple of years ago. And I also have Realty Income in my portfolio. I have just over 37 shares at an average cost of about $56.50, and right now my Realty Income position is looking good. I'm up about 11.5%, but if we include dividends in that, I'm up nearly 22%. And as far as how it's weighted in my portfolio, it's not a huge position, but it's also not nothing. I mean, Realty Income makes up about 5.5% of my total portfolio. But in the past, guys, I do remember there was a point where Realty Income made up like 10, 11% of my total portfolio. It was my biggest position by far for quite a while. But anyway, moving on to the third stock, guys. This one is Enterprise Products Partners, which is a master limited partnership or an MLP who has continuously paid out distributions since they first came onto the market back in 1998. EPD has grown to become one of the largest midstream energy companies in the United States with a network of pipelines that are connected to nearly every major U.S. shale basin and those throughout the Gulf Coast. And despite dealing with a mix of different types of commodities, EPD's cash flow is not directly impacted by commodity prices, which tend to go up and down, sometimes with quite a bit of volatility. Instead, they implement long-term fixed fee contracts, resulting in a more stable, predictable revenue stream. Now, as far as the dividend goes, they are clocking the highest yield of the day, coming in at 7.66%, and they're almost a dividend aristocrat with a growth streak of 23 years straight. And just like the first two companies we've talked about so far, I'm rocking some EPD in my portfolio. I have a pretty decent position. As you can see, I have about 73.5 shares of EPD at an average cost of about $22.50, so my position is up just a little bit. In fact, I'm seeing a share price return of about 14.5%, which is really solid, and if we include dividends in that, my total return is about 31%. Nice. Now, as far as weighting in my portfolio, EPD is not a huge position, only 4.5% of my total portfolio. But if we scroll down and take a look at how it's diversified by income, this is quite a bigger chunk, and EPD makes up 7.35% of my dividend portfolio's total income. But anyway, moving on to the fourth stock of the day, guys, we're talking about McDonald's, which might seem like an interesting pick because when people are trying to save money during tough economic times, they tend to cut back from spending money on things they don't really need. And that's why restaurants aren't usually the best stocks to invest in during a recession, because people are eating out less, so it's harder to make money. Plus, when the cost of things like food and wages go up, that makes things even tougher for restaurants. But McDonald's is a bit different. Most of their restaurants are run by independent business owners who pay McDonald's to use their brand and sell their food. So McDonald's owns the land and the building, but then the franchisee pays for everything else, like the equipment, the signs, the furniture, the workers, and the food. By using this franchise model, McDonald's can protect itself from rising costs and inflation, and they also own a lot of valuable real estate, which is another way they can hedge against inflation. Plus, McDonald's is known for their affordable menu and is one of the most popular, well-known brands in the world, which certainly contributes to their competitive advantage. Now, regarding the dividend, they've been able to increase this thing consistently for the last 21 years, and they currently offer a nice 2.3% yield and an 8% dividend growth rate, which isn't too shabby. And now moving on to the fifth and final stock of the day, guys. Of course, we're talking about Procter Gamble, but really you could go with any sort of consumer packaged goods company like Colgate-Palmolive, General Mills, Kimberly-Clark, Clorox, or any of the others. But my favorite out of the bunch is Procter Gamble, and you guys are probably sick of hearing me talk about it at this point, but it is too perfect to not include in this video. Since its formation in 1837, Procter Gamble has grown into one of the world's largest manufacturers of a lot of things we can't live without at home, even during a recession. Things like laundry detergent, baby wipes, diapers, cleaning products, shampoo, deodorant, toothpaste, you name it. While some customers might trade down for cheaper options during a recession, overall demand for most of the items Procter & Gamble sells stays pretty steady since the brands are so widely recognized and are used every day. And to prove just how stable and reliable they've been over the years, I'll point you to Procter & Gamble's unbeatable dividend growth history. They've been growing this bad boy for the last 66 straight years and have actually been paying their dividend without interruption for 132 years since 1891, which is the same year Carnegie Hall had its grand opening in New York City, in case you didn't know. Now, Procter & Gamble is the fourth out of 5 stocks we've talked about today that I do own in my portfolio. The only one I don't have is McDonald's, but regarding my Procter & Gamble position, I have just over 26 shares of Procter & Gamble at an average cost of $138.87, and Procter & Gamble is definitely a bigger position of mine. I like to have these defensive companies make up the core of my portfolio, and Procter & Gamble is that, and it makes up about 8.5% of my portfolio's total allocation. And like I mentioned earlier in the video, these stocks have performed really well over the years. If we go back across the last 20 years, a portfolio of these stocks, if you would have invested in just these 5, you'd actually be beating the S&P 500. And to do this, we are going to take a look at this free portfolio visualizer tool, which is going to allow us to go back in time and see how our sample portfolio of these 5 stocks would have performed. And in this example, we'll take a look at the last 20 years, 2003 to 2023 year to date, and we'll start with an initial $10,000 investment with $100 contributed every single week from then on out. And scrolling down, taking a look at the results, with an initial $10,000 investment with this portfolio, you would have ended up with over $558,000, compared to with the S&P, you would have ended up with $441,000. So that's like almost a $120,000 spread between the two here. That's not nothing. That's a big difference. And just by looking at the best and worst years, we can see just how defensive this portfolio is. I mean, although the best year in our sample portfolio was not as good as the S&P's, the drawdown in the worst year was quite a bit less. And if we take a look at this portfolio's return on an annualized basis, it was up about 13% every single year across those last 20 years, where the S&P was up only 9.8%. And then last but not least, guys, looking at this portfolio's dividend income over the years, in the first year back in 2003, you would have only brought in about $417, nothing too crazy. But anyway, fast forward to 2022, this last full year, in this 20th year, you would have brought in over almost $19,000 of dividend income. So that's quite a big difference. Now, these aren't the only market-beating dividend stocks that I think would be good to own during a recession. There's actually quite a bit more. And in this next video right over here, I'm telling you about 5 more dividend stocks, all of which I have in my own portfolio and I will never, ever sell. So click right over here to check them out, and I'll see you in the next one.